right, hello everyone. My name is Jeff Swanson from System Trader Success, and I'm real excited to have you here today because I'm going to explain a software product called Intermarket Divergence Pro. And I've got the creator of the software here, Murray Ruggiero, on the line with me, and he was kind enough to spend an hour or so with me today explaining the software package and showing you really the power of what it can do and how it can be used to build profitable and robust trading systems. Because I know a lot of people have contacted me and they were kind of confused with Intermarket. They weren't sure really exactly what that meant. So I thought the best way to do this is to bring Murray on here and show him, allow him to show us this product. So how you doing, Murray?
Hi, how's it going?
Murray is the creator of this software package, and if you don't know anything about Murray, he's been really involved with Intermarket for well over 20 years, a real pioneer in this field. He's also a consultant for system development at Tuttle Tactical Management, and that's a firm managing over $200 million, in assets. And like I said, Murray is one of the world's foremost experts in the use of intermarket and trend analysis in locating turning points and developing price moves in the market. So you can see he's developed or devoted a lot of years to this. So this is an excellent opportunity. And Murray, I really thank you for spending some time with us today. All right, so really what are we covering today? What we're going to cover is three main topics. We're going to go over what intermarket analysis is, kind of the theory behind it. Then we're going to go and demonstrate how to use Intermarket Divergence Pro, which is the software package that Murray created, and how to use that, load it into a chart, see what it looks like to build systems with that, and really how easy it is to do and the power behind it. And then at the very end, we're going to show you another tool that goes hand in hand with this software package. It's one you don't really need, but boy, you can really improve the performance, and that's how to optimize these intermarket systems. But
Right.
that's for a little later.
Yeah, and actually one other thing we're going
Yeah,
to talk about, Jeff, is we sold a package called Equity Curve Feedback a while ago.
sure.
And I actually developed that package to use with intermarket analysis. So I have a white paper which is a intraday S&P system. It holds overnight, but it trades on intraday bars. That I combine intermarket divergence concepts with the equity curve feedback, and I'll actually show the code for that, how simple it is to do, and the tool package that we have that has all these tools in it.
Excellent. Yeah, those are some great extras. We have a lot to go through, so I suppose we should get going here and start off explaining really, which probably is on a lot of people's mind, is what is intermarket analysis. And I'm just going to briefly preface this by saying that really what it is a way to predict the markets and turning points. And what you're doing is using another market. So I think that's fair to say, Murray, right? What we're going
Right,
to, if we're
exactly.
trading the S&P, for example, you might then base trading signals not just on the price action of the S&P, but you might go to another market. And that other market might be something like utility stocks.
Correct.
Or,
Yeah, right. The best way to think of intermarket analysis and a concept that most traders would understand is arbitrage.
hmm, okay.
That so in essence, the market you're trading is mispriced, and you're discovering the mispricing due to another market's price action
Okay,
versus
excellent.
that market.
So we have this slide up here, Murray, explain a little bit more about it. Can you elaborate here?
Okay. Okay, right. There's a fundamental relationship between certain intermarkets, especially in today's world. So, for example, there's currency pairs that are not denominated in dollars that can predict markets that are denominated in dollars. They actually will lead those markets. There's relationships between utility stocks and the 30-year treasury bond. There's relationships between foreign markets and US markets. In today's world, all the markets are interrelated.
Now, you mentioned that the markets that we're going to call, I guess I kind of wanted to define terms here. If people are really new to this, we're going to have our tradable. Let's just keep it simple. It's the S&P futures market. It could be anything.
Right.
It could be an ETF.
Exactly.
That's our tradable. But then what we're also having is the what we call an intramarket, which is our secondary market, and then let's say the S&P is our tradable. That's what we're going to be buying and selling. But the market underneath it, the intermarket, let's say, is going to be, can you give me an example?
Well, one of the things for the S&P that I've used quite a bit is Tiffany stock.
Okay.
I
Okay.
mean, that's
Tiffany
one
stock.
example. There's actually a lot of examples on the S&P. The problem is a lot of them are using proprietary
Sure.
systems,
Sure.
some of which Jeff's even offered of mine that I offer on my website. So I can't divulge those markets because actually one of the markets I've used for over 20 years,
Yeah.
and it's proprietary. And I actually developed that. Those relationships were actually something that I used back in the '90s when I worked for Larry Williams. So
Right.
that's how robust intermarket analysis is. Is that we have systems that still work today. They're using the exact same market that was used in 1995.
Sure. Sure. Which is really astounding. I remember reading about that. And we certainly don't want you to give away any proprietary, what you consider proprietary information, that's for sure. But I guess the point I was trying to make is the underlying intermarket, that has to be predictive, correct?
Correct.
So
Correct.
there's a
And that's
process
that's
here
what
of trying to find these intermarket relationships that your tool can, I guess, will help us find, correct?
exactly. That's really the key. Intermarket Divergence Pro's best suit is really helping you find what markets are the most robust and predictive.
Okay, so this is also like a testing tool to help us find these pairs that will work really well.
Exactly. And it saves you a lot of work. I mean, you could basically shotgun up to 50 markets at a time, let the optimizer run, and then when you come back, you'll have analysis of what intermarkets are the most predictive for that underlying market. And then
Great.
you
So
can go through using the intermarket divergences you found and develop a final full system out of it.
okay, great, great. Because I know that's another question that people often would ask is, how do I find these relationships? Well, there's a lot of well-known relationships you can take advantage of, but if you want to explore on your own, this tool, you can explore 50 different markets at a time.
All right, one thing I want to make a point here is
Yeah.
right now there's a lot of new ETFs coming out. And as these ETFs get more and more data, you can use some of these ETFs to predict their underlying commodities. Like, for example, if you have a ETF that looks at oil exploration stocks, well, that's very good for predicting crude oil. So as these ETFs get more and more data, we're going to be able to use these ETFs to predict other underlying markets.
Ah,
So
interesting.
so you want a tool that can do shotgun and do this analysis, because just because this was the best market 5 years ago and I told you about it doesn't mean that there's not a new hot market that just got 7 years of data that you could start using.
Good point. Good point. Okay, so that's a fairly good understanding. So we're going to be loading two different symbols on a chart at a very basic level here, and one's going to be is predictive, and then I think this goes along with your next slide here, where we're going to
Right.
call. Yeah, I'm sorry. Go ahead.
Well, basically, intermarket analysis is really one of the best ways of discovering market turning points.
Okay.
The reason for that is the fact that the markets are usually moving in one direction and will change to an opposite direction. So, for example, we're looking when bonds are going up and utility stocks are going down, we're looking for bonds to turn down.
Okay.
That's the classic intermarket relationship. So
Sure.
it is detecting turning points.
Okay. Maybe now would be a good
That's
time to.
intermarket divergence, right? That's intermarket divergence, which I invented in the late '90s.
And that's
And
really
the
what this whole tool is around.
exactly
This Divergence Pro tool. Maybe
right.
what would be good now is you listed a couple of the fundamental markets here: gold versus the dollar, crude and the dollar. Let's go. Maybe we can take a look at one on your chart there in your trade station, because I think you have that up. Okay, we switched over to Murray's screen, and Murray, what are we looking at here?
Okay, first of all, we have the at US symbol, which is the symbol for the 30-year Treasury bond futures continuous contract.
Okay, and that's where we're actually trading. You can actually see the
That's
trades being
X,
taken on that.
right. Okay, this is $ UTY. It's on the NASDAQ exchange. This is the Philadelphia Electrical Utilities average.
Okay, so that's a okay. That's just an index. That's not an
That's
ETF.
right. That's an index of utility stocks, and it's actually something that I've used on this type of intermarket divergence trading all the way back to the mid 1990s. Before this, there was actually something called the NYSE utility average, which got discontinued.
Okay,
So I built a system that I published in 1990 in 1997 using that, and I just substituted out the Philadelphia utilities without even changing the parameters.
awesome.
And the results were very close.
That's a good
And
sign of robustness if you could switch over the indexes. But yeah. So okay, then we have our tradable at the top. We have our intramarket, which is the utility index there,
right,
and the Philadelphia index.
right,
And then we have below that these two squiggly moving average lines. So what are
right.
those?
Okay, this is close minus a 2 period moving average of close.
Okay, so that's actually that's referencing the tradable, the
Right,
bonds, and
exactly.
that's just basically a moving average. Now, most people would expect to see the moving average on the price bars, but you just put them into a pane, and the zero line is representing price, I assume,
No, the zero line is representing when this oscillator crosses zero.
when the oscillator crosses zero. And so when
Right.
it crosses zero, what that basically means is the price of the utility bonds are trading above that
No,
moving
what
average.
this is, no, this first one is price of the underlying of the one we're trading.
Ah, okay.
So what we're saying here is that say so we have a buy signal here, daily bars, which means it got generated here. And right here you can see that the yellow one crosses below zero.
Okay, yep. See
So
that?
bonds are going so bonds are in a downtrend, a short-term downtrend.
Okay.
And now we have the utility stocks. That's what this second one is we're referencing the utility stocks on this second one. It's the same kind of indicator. So this is the close of the utility stocks minus a 6 period close on the average and 6 period average of the utility stocks.
Okay.
So it's utility stocks close minus an average close over the last 6 period. And again, I monitor it versus the zero line.
Okay.
We see here it crossed
Yes.
here
You can
above
see
zero.
that the utility index down there is crossing, it's above, but yet you have on the right there on that buy signal, what you have is the divergence where you have the
Right.
US bonds are below that zero line and the bonds are above that zero line.
And the utilities are above.
Yep.
So the bonds are below and the utilities are above. That's a divergence because they should be positively correlated.
And that's the whole
And
theory behind this, that these should be correlated, positively correlated, and you're finding a divergence. And so what you have is the bonds are moving up, but yet you see the bonds are actually pulling back while the utility stocks are climbing, and that shouldn't happen, and that presents a buying opportunity.
exactly. Let's take a quick little look here.
Mm.
This
Okay,
system,
bringing up the results here.
right. This system's made $182,000. I don't think we subtracted slippage and commission from this, but obviously, with an average trade of $510, slippage and commission is not an issue in whether this is profitable or not.
Right. Clearly, this would be a profitable system. So excellent. Yeah, those
And
are
you can,
really solid results. And those are
and you
the
can,
annuals.
right, you can see only 212 was in the hole.
Oh yeah, 212 was a losing year. Yeah, it's very impressive results. And yeah, that's
There's the
really an
equity.
amazing looking equity curve. And to put something like this together really was pretty simple. And I want to let people know that, when you first look at this, this looks a little confusing, but don't let this confuse you. Essentially, what we're doing is like what Murray says, looking for an arbitrage situation. We know that the utility index and the U.S. bonds are correlated. And so we just add some moving averages here, and we see when that divergence happens, where the utility was continuing to climb and we saw a pullback in the U.S. bonds. That's our divergence. That's when we pull the trigger to go long. And I guess a short signal, Murray, would just look opposite.
Right. A short signal would be when the utility stocks are going across below, and the bonds are above their moving average.
Sure. Just the, okay, excellent. And also how this predicts turning points. I think if we scrolled over to the right, I think there was a great example of how it was really just capturing. I don't know if it was the right or maybe this one. Yeah, or this turns.
Well, here's not a. This isn't a bad little sequence here.
Yeah, look at that sequence. It's really good at picking off these points.
Oh, here's a nice period.
Here we go. Yeah, look at this. It's just uncanny in how it can pick some of these points. You can see when from the far left and moving down to the right, look at all those trades
Well,
as
and
they.
if you look at this sequence, let's actually. All right. So here we are. We get our first winning trade in July, and we don't and we're all winning all the way until September.
Yep.
So you get 2.5 months of perfection.
Right, which is a pretty good.
And it's not one trade. It's one, two, three, four, five, six, seven, 8 consecutive winners.
Right, right. So I just wanted to highlight that's fantastic, and that boy,
And
you can really
actually,
see.
that doesn't happen. And look here,
That's another.
there's another sequence here
Yep.
that goes from March with the next losing trade in May. Another 2 months of perfect.
This really is a powerful technique in locating those turning points, that's for sure. And that's what I find. Obviously, it's not perfect. Well, of course, nothing's perfect, but boy, does a really good job. Now, Murray, can you just trade futures with this, or what if I don't want to trade futures?
You can trade futures. You can trade ETFs with it. You could trade forex with it. You could basically trade almost anything with intermarket analysis. It just on some of the stuff it becomes harder to try to find the relationships because they might not be as obvious, and some
Okay,
of them require more research. Like for example, certain stock sectors you want to be looking at different currency relationships depending on the stock sectors. Like for example, the Dow Jones index, you want to use the dollar index, while the S&P you'd use different currency pairs. But you'd use the basket of currencies on the Dow Jones, and there's certain currency pairs that work better on the S&P.
okay, great. Another kind of comment or question that does come up, and I know this is something that you wanted to explain, is those relationships that we see between the tradable and the intermarket. Is there something really predictable there?
Yes, it's very predictable. And I'm actually going to explain a test I did. I know this stuff works. I've been using it for 20 years. I've developed systems that I've traded for a long time. A lot of the stuff we use at Tuttle's, we have a lot of intermarket based systems. I know this, and I've been working with him since 2007. Um, at least supplying him some technology. So it's been a long time.
Okay, and you mentioned a test that you did.
Right. So here's what we did. We're going to look to see if intermarket analysis is really significant. So we're going to design a statistical test to prove it. Basically, one of the things people keep telling me is that, well, if I just use two different moving averages of the same price series, I'd make a bet I do just as well.
Hmm.
Which of course isn't true. Not if you pick the right markets. All right, so what I did is I designed a simple test. This is actually in Trader Studio code. I mean, you can easily do it in TradeStation code, but I actually ran these tests in Trader Studio. So what we did is we simply just took the moving average of the underlying market,
Is that the
and if
first
that
part? That's what this first part is up here?
right, right, it's close minus average close S length. So
Gotcha.
it's so we just took the close of the close minus the average, made that an oscillator. When it's greater than, we buy, and when it's less than, we sell. That's
Gotcha.
our that's our bogey. That says that if we didn't have any, if there was no relationship here, that system should do just as well.
Yeah, and really that's just a moving average. It's a moving average system, right?
Right. So now what we did is we wanted to compare apples to apples. So comparing this to intermarket divergence would not be fair. But comparing this to just the moving average of the intermarket is fair.
Oh, okay. So this one up here, if I understand you right, is done on the tradable. Is that right?
Right. Right.
And this one down here,
Is done on just the intermarket. We don't even care about the divergence.
gotcha, gotcha.
So this is not as good as using the divergence, but I want to show that the underlying market is predictable. All right, so I ran this experiment on the utility stock, the example we just had in the 30-year Treasury. And I used the Z test, which is a statistical test that tells me is if the distribution was the same. Now, what I did with that other code is I optimized all the parameters across a given range for both examples. So I ran the first system, which just looked at the bonds
Hmm.
and ran an optimization, and then I used the second system that only looked at UTY and ran an optimization.
Okay.
And then I ran a Z test on the two distributions. And what I wanted to prove is that they came from a different distribution.
Mm,
That basically so I did significance testing to test the hypothesis that they both came from the same distribution.
okay. And
So the
what'd you find there?
well, what I found is that this relationship is statistically significant at the 97.8% confidence level.
Okay, so that clearly passes the significance test.
Exactly. Now, remember, this is trading. When you run these, a lot of people will use these, try to use statistics, and something will be at the 90th percentile
Mm,
and say, well, that's not really good because we want to see at least 95% usually when we're running any sort of hard science.
sure.
But this is trading. Things aren't perfect. This isn't like looking at a correlation of, to predict whether something is a malignant cancer, where
Right.
where we need 90% plus accuracy to make it feasible.
Yeah, or 99% or something.
Right. Exactly.
Yeah.
So this is something that if we were 60% right, we could make more money than we could ever spend.
So this significance test, what you've done here with this code and then the results that you found here really demonstrate statistically that there's significance here. There is something here.
Exactly.
But even beyond this, just because you've had trading systems that you've built nearly 20 years ago using this concept still work today with very similar very unoptimized numbers or unoptimized inputs, really in the real world, there's a lot of demonstration that this continues to work. And as you pointed out before, you continue to use this as a viable way to build systems.
Right. It's actually one of my main ways. If I need a new system for something, the first thing I do is try to figure out an intermarket for it because
Yeah,
it's the easiest way of doing it because, you know, I'm as lazy as everybody else in terms of getting the job done. And I know that if I come up with a good intermarket system, it's going to work.
sure. And I think that's what it's so important that people that are into system trading, like obviously everyone watching this is that really you should learn this, and it's not a lot to learn. I mean, you can pick this up pretty quickly and then really explore this because it's a great tool to have in your toolbox because it is so powerful. And like you said, Marie, it's your first go-to tool to go to when you want to build something is you go to Intermarket and start looking there. So I think that says a lot about this.
Right. And what's key is when you start thinking like this and thinking about intermarket, then you know how to approach things. Like for example, if I need to predict the market, I'll start looking at some of the indexes I think might be predictive. I'll pull up the sheets on them to see what stocks they contain
Yep,
and what percentages of what stocks. Because let's suppose you have an index that kind of works. Well, now I might look at the individual stocks and see how each individual stock works.
sure.
So, for example, in that utility average, if you say, well, can I come up with something that works better? Well, now you might look at those stocks and start analyzing those and make your own utility average to predict bonds.
Interesting idea. Definitely an interesting idea. All right, Murray, at this point, let's turn it back over to you where we're going to take a look at the TradeStation environment again. And let's actually bring up a new chart and load Divergence Pro on it and see what it looks like and how somebody would get started looking at intermarket divergence on different markets. So I'm going to pass this over to you.
All right, so we have a workspace up here, which is one we use to show the simple, the crossing over.
Yeah,
So you want to make a new chart, you go to the apps chart. This happens to have a daily U.S. bond already on it
okay,
because that was my default symbol. But of course, if you were going to, you would just use the insert.
okay.
All right, so now we're going to insert UTY.
Okay, so now we're inserting our second symbol. And I think some people probably didn't even know you could do that. You can go up there and insert a second symbol.
Right, exactly. So now you can insert a second symbol, and now we get UTY here.
Excellent. So it's that easy to load two symbols.
Right, and then we go insert strategy and intermarket divergence pro. Now the thing is, if you're going to be doing optimization in Windows in TradeStation 9.5, then you have to use we have a separate version which has got the underscore 95 on it. Okay, so we add this to it. Now we have parameters. Interset is the intermarket number. So 2 means data 2.
Oh, okay. So that's telling you which intermarket. So data set two, gotcha.
Right. Now, just to foreshadow what's coming, is you can optimize this parameter.
Oh, okay. So you could load on like be five other symbols and then optimize over those to figure out which one's the best one.
Right. You can actually load up to 49 symbols.
Okay.
Okay. Long, short, or both.
Okay, so that's going to control if you're going to take long signals, short signals, or both. Gotcha.
Right. Okay. 0 means price minus price n bars ago, and 1 means price minus the moving average. So you have two different types of trend indicator.
Okay, that's your for your trend indicator. Is that what we're using to determine if it's above or below the zero line?
Exactly.
You have two
So
different
close,
methods. Okay, so
and
that's all that is.
here's the parameters for the look back of either price or the moving average.
Okay, so if people remember that there's moving averages we apply to each market, and that's just simply the look back parameter.
Right. Relate means is it a positive relationship or a negative relationship?
Okay, and in our
And
case,
then
we were looking at a positive.
and then we have a whole bunch of things here. We have these true false parameters, which allow us to um, make exit rules and entry rules. So we have a filter for our entries. So, for example, we might require RSI to be below 50 to buy because
Oh,
we don't
okay,
want
so
to
you can
buy
actually plug in code right here
exactly.
as a filter. Ah, very clever. Very clever.
And also, we get exit. Like, for example, one of the problems with intermarket trades is if they last too long, they're usually bad.
Mm,
Because what happens is you get trapped and the divergence gets trapped. So a common filter you might use is you might say, I'm going to exit the trade after 15 bars.
I see.
So
Okay,
you
so
could
you can
code that
plug
in
in
there.
different entry and you can actually enter in here different filters for entry and exits. Great.
Right. So you can actually create exits.
Okay.
So really, okay,
What's
this
the
is
hold?
holding period.
Yeah,
Okay,
what's that?
hold at -1 means don't ignore this parameter. Otherwise, you could do test and say, if I get an intermarket divergence, I want to see what happens 5 days later. I want to see how predictive is it of the next 3 days, 5 days. So you could try to figure out for a different intermarket divergence, what is the optimal prediction period?
Oh, so what is price doing 5 days later after the divergence?
Exactly.
So if you put that in there, or if you activated that, I guess you would put a five in there, for example, and that would be exit 5 days after the divergence.
Exactly.
Okay. And like you said, that would be that you're what you're testing is the behavior after the event. And you can test a range of dates, maybe 1 through 10.
Right. And then the last one, if it's 0, we just enter it the next bar is open. If we put a number in here, which is a percentage, we actually can enter on an opening range breakout after the divergence.
Okay.
And what and what and the thing is, that's the feature that unfortunately we lose in 9.5.
Oh, really? Okay.
If you want to run it as a multi-core version.
Okay. If you run a single core, though, that feature will still work?
Exactly, because
Okay.
then you can use the DLL. You just can't. There's no thread safe way that isn't torture to,
Okay.
to do the next open. I mean, but you can see. I mean, think about if you wanted to do all this research and intermarket analysis, how much coding if you didn't have a tool like this you'd have to do.
No, it's significant. It's certainly significant.
Okay,
Okay, so I guess we're
so
gonna change some of these
okay, so
parameters.
yeah, so we'll use a so we can optimize the type. And we'll optimize these two. Now, I use usually from 2 to 30 in steps of 2.
Okay,
Now, one other point I want to make is you can use intermarket divergence on daily bars. You can use it on intraday bars.
true. Okay, good point. Yeah,
Um,
and I think a lot of people don't realize it that, yeah, like you just said, you can use it on intraday bars. So you can actually build a system on intraday bars with this.
okay, there's 450 optimizations. Not a big deal. So we'll just optimize.
Okay, so you're optimizing over the type. So that's the type of moving average we're using for that
Right.
oscillator, and then
And
checking the length.
right. So now we have our results. There's our equity curve.
Those are the optimal values.
Right. Those are the optimal values. But let's talk about something for a second here. Okay, let's look at this.
Sure, and I think you can even just look at here. You got points 2 and 6 are for the lengths, and so if you look at neighboring ones, let's
Right,
like
two and
2 and 4, right, and then
2 and 8.
2 and 8. They're all up there. They're all very profitable, very
Right.
respectable results. And let's see, is there
So
another
so
one? 2 and 10,
right. So in
two
this
and
case,
12. They're all up there, right?
right. So in this case, 2 and 6, even though it's the best set of parameters, is probably safe
Yeah,
to take. But there are times that you might be taking something down here, or
sure.
you can look at the drawdowns.
You know what,
See, that's
Murray?
kind
Let's
of
just pick one. Let's pick one. Let's pick one further down. Let's not as optimal. Just to see what even a non-perfect one would look like. Let's pick like 2 and 10 or 2 and 12.
Well, actually, let's pick something here. Now, the 2 and 10, just as an FYI, that's actually I can make an argument that that one might actually be better for some people because
Oh, the
uh,
drawdown.
the drawdown's less.
Yep.
So
Yes,
let's
some people might be more interested in drawdown
right.
as opposed to pure net profit. So this is the one that's obviously, wasn't the optimal one, but look again, look how great that looks. And let's look at that results. Yeah, can you maximize that so we can take a closer look?
Okay, and
All right, 142.
there's a trade list.
Okay, here's the annual returns.
Right, so that's 2012 was our big problem.
Yeah. Well, to me, every system can't be perfect.
And
I mean,
there's their equity graph.
now let's consider this. Look how quickly it was. You loaded two symbols on there. Obviously, we knew that the utility is a leading indicator, but that's okay. Look how quickly you put this system code on there, optimized over two different moving averages to determine a fair value. And look at this system, and nothing else was done to it.
Exactly. We didn't add stops.
But what about even this system right now, Murray? As it stands, like right now, as a system, is this tradable?
With a 16 grand drawdown, so figure a 35 to $40,000 account. Yes.
To me, yeah, this really does look pretty close to tradable, if not tradable. Obviously, it
Well,
depends on your personal preference, but this is very, very close, if not tradable, out now, right now as it
right.
stands. And it's pretty impressive that just really a few minutes of work will get this to you. And if you start playing around with it a little bit more, maybe adding some stops or some other filters to to get it to your exact liking, Wow, it's going to save you a ton of time, and this is really impressive that you could do this so quickly.
Well, now another thing I want to mention is
Mm,
intermarket analysis works in a lot of markets. So
yep,
actually, if I was going to trade this, and this is all I had to trade, I wasn't going to do any other work. I would work on a system to trade either ES next, and I would trade both in the same account.
sure.
Because believe it or not, when you take two different intermarkets, that gives you diversity. Because if you're using another underlying intermarket besides the one you've already used, that gives you diversity.
Exactly. No, it's
So,
always great to diversify over different
so if
markets.
you trade ES and you trade the bonds, what will happen is that equity curve will smooth out quite a bit.
Sure, sure.
In fact, for example, in the proprietary system that we traded, um, we ended up it did great in bonds up until about a week ago, and it actually had a large losing trade recently, even though it's still up a lot of money since we first offered it. Um, but the S&P system was in a monster winning trade.
Yep.
So so the same type of thing. If you have a couple different intermarket systems, they use different intermarkets and trade them together. One might win, one might lose. They might both win, and you lower the drawdown, and now you could actually still trade two systems with the same $35,000 to $40,000 account, and the $16,000 drawdown isn't a problem because you're trading both together, and you probably have like a $12,000 drawdown
Yeah,
when you
yeah.
when you add the two together, and the profit of both.
Now, Murray, at this point, I think what's maybe another question that's going to come up is, okay, we know, for example, trading the U.S. bonds, that using the utility index, we knew that that was going to work. What if we just had a symbol on here and we wanted to test different intramarkets? How could we do that?
Okay. Here. I think this is the one. Okay, this shows what we just did. Okay. All right. What I did here, and we can go here, is I loaded a bunch of symbols.
Okay.
And you could load, as I said, up to another 49 symbols.
Yeah, okay, you can put up to 49 in here. So you got your US Treasury 30-year, and then on data 2 through 5, you have a bunch of different, you have an index, several indexes.
Right. I have an index. I have the RightX utility, which is that's the Act 40 mutual fund, RightX, that's the utility sector. I have the Dow Jones utility average, and
Okay.
I have TLT because I'm looking for positively correlated symbols.
Okay.
Now, if I wanted to look at negatively correlated symbols and create a market, I could use things such as gold. I
Mm,
could use the Fidelity Select Chemical Index.
okay.
I could I could I could use metal indexes. I could search for anything I could think of: crude oil, nickel, and add all them in and then do the optimizations.
Okay, and see which one performs best.
Exactly. So let's actually run this optimization. And what we'll do is we'll discover how we ended up with the Philadelphia Utilities average.
Okay.
Okay. So what we're going to do is we'll just optimize the intermarket. So we have 2, 3, 4, and 5.
Okay. Okay, looks like the optimization's done.
Okay. So the first thing we want to do is we're going to look at the optimization grid. And what I do is I will take some cutoff. Let's say the top 20 sets of parameters. And I'll say, how many times does each market appear in the top 20?
Okay.
So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times the number 2, which is the Philadelphia Electrical Utilities average, appeared in the top 20.
Gotcha.
So now we look at the fourth market. 1, 2, 3, 4, 5, 6.
6 times. Okay.
And then we've got the 3, which occurred 1, 2, 3
And 5
times.
doesn't even show up, I guess.
Right. So in essence, so based on this analysis, we would pick the Philadelphia Electrical Utilities average as the market that we would trade.
Gotcha.
So that's the power of this tool. So if you throw, imagine you threw 50 markets in.
Right. You can
This
literally go in, take like the S&P, throw in 50 different markets. Some of them might be futures, some of them may be indexes, some may be individual stocks, and you can quickly test. Not only is it positively correlated, maybe it's negatively correlated, and then you can also determine which particular market it is.
the truth is, TradeStation has a lot of funky indicators that are built in as data streams. Of course, you have TRIN, which is
That's
the
true
ARMS
too.
index.
Yep.
You've got number of stocks above their 200-day moving average
Yep.
or above their 50-day moving average.
These so-called breadth indicators you can throw in there.
Exactly. So all those could be thrown in here and treated like intermarkets. In fact, I'll show you an S&P trading system that uses that in a little bit, and it uses the same tool.
All right, excellent. Thanks for showing how to explore different markets there, Murray. Now, I guess what we want to move into now, you want to demonstrate the power of this tool by showing us different relationships in different markets here.
Right, exactly. So it isn't just predicting bonds in the S&P, and that's a question I get a lot. It's like, well, except for bonds in S&P, can you do anything else with it? Yeah, you can. You can do a lot. So here's crude oil. And again, you're seeing daily stuff here. But you can do intraday relationships too. There are very strong intraday relationships. In fact, I've had a gold system that trades 45-minute bars that's existed since 2012 that I'll have to re-optimize about every 2 years. But the system has done very well and it's held up. In fact, it's up 16,000 this year
Wow, that's impressive.
on one gold contract. Okay, so now here's crude oil. I've been asked about crude. So we're using the XOI index and we're using the dollar.
Okay. So this one's a
Um,
little different. This one's a little different. They're using two intermarkets.
right. This is another one of the tools that comes in that Intermarket Divergence Pro package.
Ah, okay.
Okay, this lets me set two intermarkets. So now I can optimize two pairs of market. So let's suppose I set up my chart where market 2 to market 20 is positively correlated, and market 21 to market 50 is negatively correlated.
Ah.
So now I could do those optimizations like this
Mm-hmm.
with knowing what those relates are, and test the pair of markets. So they have to confirm the divergences have to confirm each other before I take a signal.
I see. Interesting. Okay.
So I could test two different pairs. So for example, just because UTY is the best intermarket for bonds, that might not be the best positively correlated market if we're correlating it to a bunch of negatively correlated markets and doing confirmation.
Okay.
So this tool would let you find that out.
Interesting. Okay.
And again, you have the filters on the entries
Yep.
and the filters on the exits. So anyway, we ran this and did this study for crude oil. So out of the box, we make $205,000 on crude in the past 10 years. And you can see now crude's a minute. It's like, yeah, but crude's gone straight down. Well, we make 84,000 on the long side.
Right. Right. It's
Almost
clearly the long and short side are both doing pretty well.
almost $1,800 a trade. And you can look at the performance.
Yeah, it looks incredible. Looks great.
This is just out of the box. And actually, this is what's interesting too. And there's something that way down the pike, Jeff and I have talked about, is I've done a lot of work with intermarket currencies.
Mm.
And people think that you can't trade the currencies with intermarket. And I'm actually going to give you one of the worst relationships that's still workable that I have, because I'm not going to give you the best, because I actually had a proprietary book I did for a client, which my embargo is actually ended on.
Oh, so you can reveal that shortly or later on,
Right.
huh?
Yeah. So I'm actually in the process of updating the book.
Oh, excellent.
And the book was all on intermarket currency systems.
So I guess not, until then, let's see the bad one.
Okay, this is the Australian dollar,
Okay. The Aussie.
and we're trading the Australian dollar with market three. And market three is actually a variation. Let's look here. Market three is worldwide commodities. So basically, the Australian dollar is a commodity index. So in the book I did, I actually used the Goldman Sachs index. But the problem is they don't have the Goldman Sachs index as
So
a
you got to find something
continuous
equivalent. Hmm.
as a continuous right. And this is the example of why you have a tool like this.
Yeah.
Well, it's like I know the Goldman Sachs index is correct. So what I'll do is I'll search for all indexes and all mutual funds in which the word commodities in them and shove them in and test.
And test them. Excellent. What about that
Well,
long view
how
commodities? The long view commodities index. What's that one's used for?
that was not as good. I did the testing just like I'm telling you to do.
Okay, so you tested these two.
Right. And found out that this world commodity index was the best.
Best one. Okay.
And let's look at that those results. And the problem is when you start testing these weird indexes, sometimes you only get 5 years of data.
Yeah.
So for
Obviously,
a five
right.
so for a 5 year system, I don't think those are bad results on something that's not that volatile like the Australian dollar.
But these results, boy, these are looking pretty good.
Yeah,
Like
and
you
I said
said,
this
there's some give and take, like you said, because some ETFs are not going to have the history there,
right.
or
So
some
14K,
indexes.
right. So you've got a drawdown here of 17K, 63,000 made. Equity curve, there's not a lot of trades, but if you look at the performance, except for 2013,
Yeah.
which there was
This
a lot of manipulation of currency, if you remember.
this is a type of system that maybe there's not enough trades to really want to have to feel comfortable with, but this is something that I would put in my back pocket and be watching over the next year or two and see how it behaves, and would consider it a viable system then.
Well, let's look at it this way. What would happen, and I haven't even tested it, is this doesn't have enough trades on daily bars, but what happens if we go down to 45-minute bars?
Good point. That's another way to generate more trades. Lower that time frame down, and you generate more trades. That's true.
Right,
And
and when
and
you
you
got an
made the
average
point.
trade of $1,000, $900, well, the intraday system might have an average trade of 100. Well, that might still be workable.
Yeah, exactly. That's a whole other area you can explore. So, yeah, that's a good point to bring up that I know we brought it up before, but this doesn't work on just daily bars. It's going to work on weekly. It's going to work on intraday. You,
Correct.
you probably wouldn't work on this with tick bars. I never
No,
touch those.
no, I never touched those either.
Those are always a pain to back test with.
Okay, now let's look at another relationship. It's like, well, I don't trade futures. I don't trade currencies. I
Right.
trade stocks and ETFs. Bam. XLE, which is the oil stocks. Here's the system that trades the oil stocks. Makes 50, and if you want to trade them only on the long side, it makes 57 points on the long side over a period of 10 years.
I think
The index is only 67.
what you're doing here, you're just trading one share, correct, Murray?
Correct.
Yep.
And I did optimization here, as you can see. So you can see it's really robust. I mean, we got into some negatives way down here, but look at where the negatives start kicking in.
Right.
We
Right.
don't we don't lose money until combination where are we? 5,300
Yeah.
out of 6,700.
Clearly pretty robust here.
You can see nice performance.
Yep, looks good. Again,
Not a
might be
lot of
few on the trade. Again, it might be a few number of trades for some people, but what you can do, like you said, is move it maybe to 60-minute bars, 45-minute bars.
but here's another point I want to make about these intermarket relationships.
Hmm.
Okay, this is an ETF of oil stocks.
Yes.
This is the index of oil stocks. So here's my question. Yeah, there's a few trades, but if you can tell me a basket of oil stocks that is a common index is not predictive of the ETF of oil stocks. If you tell me that that relationship could happen by chance,
Right.
then so maybe this is good enough to trade
Sure. Sure.
because even with a few trades, because it's such a fundamental strong
Right.
thing.
The
Like for
connection there
example,
would seem to be so obvious and fundamental.
right? Like so, another one would be is if you use crude oil and predicted XLE, that'd be something that to me would be so fundamental that it couldn't be by chance.
Exactly. Right.
That might be okay to take 50 trades on something like that. Okay,
Okay.
then we have another example, TLT. TLT is the 20 plus year bond ETF.
Bond ETF. Excellent.
Right. And now it has its inverse cousin TBF, which is the inverse of the 20-year bond. So we would take on the short signals we'd buy TBF, and on the long signals we'd buy TLT.
Hmm. Interesting. Okay. And it looks like you're
And
using the same underlying.
I'm using the Philadelphia Electrical Utilities average.
Yep.
And look, the average trade is 70 cents. So running about 60 basis points.
Wow. Okay. And again, that's 70 cents, one share.
Yep. Right. So let's look at the periods here.
Hmm.
Okay. So periods, last 12 months, you've made $43 trading long and short. So that
Yeah.
means you made $43 off a starting price. Sorry about that. Of what? Let's go to the second page. I want to make this point here because this is important. Okay, let's go right here. So that's 130. So you made 43 dollars on 130 target. That's 25% return.
Yeah. That's fantastic.
So, so if you traded this system, you'd have slippage and commission involved. So, but my bet is this system in the past year, if you had this back then, could have returned like 20%. Go trading TBF and TLT.
Yeah. It's a great example. All right. Did you have any other markets to show or?
Okay, right. Here is the trend indicator.
Oh, excellent. So what you got here is the E-mini, and you've got the Trin at the as the intermarket.
Right.
Excellent.
So you could also use stocks above their 50-day moving average, stocks below their 50-day moving average, stocks above their 200-day. All that stuff is actually built into TradeStation. Look up, and then you start looking at indexes. You've got these native indexes to TradeStation, and you've got this giant list of stuff here. Put call volume, all this stuff.
Right. If anyone has ever gone and looked at this, there's an amazing amount of information that you can pull out here, breadth indicators and
So think about taking these 50 at a time, the ones that you think would be positively correlated and the ones that you think would be negatively correlated, and shotgunning this.
yep,
Think about how much research you could do in a matter of a couple days using this tool.
exactly. And that's really the power of it, allowing you to test those different intermarkets. That's cool. Very cool. All right, so this is interesting, the trend. So,
Yeah,
yeah,
and actually, let's look at the results
yeah, I'm
because,
curious about this one.
okay, not bad.
No, not bad at all.
Look at the winning percentage, even on the short side.
Yeah, yeah, look at that. Oh, that's good. That's really good.
Now, if you've tried to build S&P systems, how many times have you been north of 60% on the short side?
Right, right. It's difficult to trade the short side on the S&P on the system, particularly on daily bars, because of the upward bias.
Exactly. So, how many times have you seen over 60% on the short side
Yeah, you
out of the
don't.
box?
Yeah. Like you said, right out of the box. Nothing's stopping you, I guess, from taking this code and tweaking it. And what's nice
Right.
about this intermarket stuff is because it's open code, you could cut and paste and come up with your own, integrate it with your own coding. You could add some old filters. You can integrate this with your own coding as well. I mean, because it is open source.
Right. Now, what I'm showing now
Mhm.
is a white paper that I published in February.
Ah, okay. So we moved over to a 45-minute bar.
Right. To show this can be used with with intraday data. And this also includes a tool that Jeff has sold for me before, which is the equity curve feedback tool,
Right.
which I actually developed for the intermarket example. This is a um, stripped down, um, not as good version of my proprietary systems that I trade on ES that uses this technology. So I created something that I didn't mind giving away,
Right. Gotcha.
but it's
Okay, so
still
what do we
very,
have?
very
We got a lot of things on here. What are all these?
okay. Let's do this to do that. Okay, first one is the is the S&P dividend sector.
Okay, these are okay. So you have three intermarkets here.
Right, advanced declines and steel stocks. Now, steel stocks actually have been something that I've used back from the 90s
Yeah, that's an interesting idea.
because it shows how strong. But think about this: if there's a lot of building of buildings going
Yes.
on, a lot of construction, they use a lot of steel. If there's cars being sold, they use a lot of steel. So if you're selling cars and building buildings, the economy's doing good.
Yep. So that's like a
And,
leading
and
indicator.
right, and remember one thing: the stock sectors. There's more research done in stock sectors than anything else. So the stock analysts are researching, future earnings of different sectors or the stocks within the sectors.
Sure.
So because of that, those stocks are going to move before the economy actually does. So the underlying stock sectors are leading indicators. Okay. So we built this. This is, and I'll explain so we know what the three intermarkets are, and we'll look at the results, and then we'll look at the code. Okay, here are the results over the past 8 years.
Okay.
Trading 45-minute bars.
Wow.
Again,
Yeah.
look at that short side number.
Yeah. Look at that. 65% on the short side.
Now this trades, this holds overnight. $13,000 drawdown, very good.
Wow. Yeah.
And we can look at profitability. 2014 was a bit of a problem. We only won 64% of our trades,
Yeah.
just about broke even.
Kind of a
But
scratchy year.
otherwise, you can look at it. It's up 10,000 this year.
Yeah. On 30 trades.
As I said, I released this in early February. If you look at the breakdown on the weekly basis, we can see that we haven't lost since March 20th.
Yeah.
Had
Yeah.
a
The
little
1300 low.
trouble, had a little trouble in early February.
Right. Right.
But before that trouble, we had a nice run. A little trouble in December, but before that, we had a beautiful run.
And so you said you released this in February, this system?
I released this in early February, in early February, right around the 7th of February. So I
Okay.
can't quite figure out if this counts or not. I'm trying to figure that one out. But even if we assume it does, the system is still way up over that period.
Sure. Excellent. Oh, looking really good.
So let's now look at this a little closer. Okay, here's the system. Now, as part of my Intermarket Diversions Pro package, actually, as part of the equity curve package, I have these intermarket signal generators.
Hmm.
So this is type, intermarket number, market I'm trading length, and intermarket length.
Okay. So that's actually the code there, a function call, passing those
Right.
values in.
And now we have the equity curve for each of the. So this produces a -1 when I'm a -1 when I'm short and a 1 when I'm long. So you do all the work with Intermarket Divergence Pro. You find the markets you want to use. You can find parameters to try it with and then optimize later, but you could find starting parameters to test the concepts.
Okay.
Now this is part of the the equity curve feedback tool. You pass in the signal, which is going to be long or short, one or negative one. True means use open trades, and this gives you back an equity curve.
Gotcha. So those are simulating different equity curves,
Right, and look at the
simulating
bottom here.
trades.
I'm tracking these equity curves down here,
Yep.
an indicator.
So what those are your three different equity curves there in those three different colors on that last chart.
Right, and that's three different equity curves of three different intermarkets.
Gotcha. Yep.
So what I do here is when the three signals add up to greater than zero, meaning they
Mm.
all three agree, that's only when I take a trade.
Okay, so that's when the intermarket coming back from the intermarket signal function,
Two,
all
two
three
of
of
the
those have to
three
be
have
above
to.
zero.
No, no, actually, two of the three is at
Two of
zero. Right. So they have to see. So we bet the one. We bet the confluence of them.
okay, got that. And then the next one must be
And then the next one, what I'm doing is you see here, I'm looking at the equity difference based on a look back,
okay.
momentum
You're
of the
simply
equity
looking
curve.
at the current equity based on what it was number of days back or periods
Right.
back.
Exactly. And when you add up all three of these equity curves for a given window, they have to be above zero.
Okay,
Otherwise, I don't take the trade.
gotcha. So you're filtering the trade based on not only the intermarket signals that are happening, but the positioning of the equity curves.
Right. And then my exit gets out without looking at the equity curves because I don't want to get trapped and take a
Right.
chance.
You always want to exit.
So look at that, how much code. I mean, yeah, the back tester is complex, but that's not something you could consider a curve fit
Right.
because that's just a back tester. That's just an indicator.
Right. Right.
So think about how little code is here.
Yeah, it's very little code, and to me, a sign of a good system is always simplify. And the simpler the code, the less code there is, the probably more robust it's going to be and hold up over time.
Right. And if you look at it, so you got this system here, which is a kind of system that, let's put it this way, you would pay between $500 and $1,000 for, and it's
Easily.
basically it's basically a white paper um, article and demo with full code, with full disclosed code, as part of this package.
Yeah, that's an amazing bonus because it shows you not only how to use the intermarket, but also the feedback as well, and combine them in a unique kind of way. It's almost like a voting scheme,
Exactly.
of what's going on here.
Exactly.
Excellent. No, that's really impressive. That's a great example of some clever programming that you can use in your own system development. That's for sure. It just shows you what you can do with these different tools and how you can piece them together to create a complete system. All right, Murray, thanks a lot for showing us all that information. That was a lot of information, a lot of great information, and I hope we answered a lot of questions and how we load intermarket into a chart, how we can test over different intramarkets, and we actually saw also some great examples of systems that you can build with this. It's really impressive. It's an awesome tool, and I hope everyone watching this goes and gets a copy of this because it's absolutely fantastic. If you're into building your own systems, you're definitely going to want to take a look at this. So I just want to thank you for your time in regards to taking a look at this at Intermarket Pro. All right, at this point, what we're going to do is take a look at optimizing intermarket systems. And in this time, we're going to take a look at your latest tool, which is optimizing intermarket systems with this new tool. So I think the best thing to do is I'm going to pass the screen off to you so you can show us your TradeStation setup and you can explain kind of what's going on.
So basically, now here's a question we have. Now, so for example, when we look at bonds, we're saying that utility stocks are in an uptrend and bonds are in a downtrend,
Mm-hmm.
and that means we want to buy bonds. But the question is, how did we get to that state? Let's call that a state. That's the state of intermarket divergence.
Okay, and I think what we've been calling that is the current state.
Right. That's the current state. So how did we get there? Now, did we get there because bonds, the utility stocks were in an uptrend, and then bonds went into a downtrend and then into an uptrend? Or did we get there because both of them were in a downtrend and then the utility stocks turned into an uptrend? But the question is, how did we get there? Did we get there because utility stocks were in an uptrend, bonds were in an uptrend, bonds turned into a small down, went to a downtrend, and then we bought because now that's a divergence? Or were they both in downtrends and then utility stocks turned into an uptrend?
Yeah, I think the point here is at the current state, traditionally, when that divergence happens, we just buy. But the question you're asking is, well, what was the state prior to that? That's really what we're looking at. What happened just prior to this trigger happening?
Exactly. And what you'll see is that based on that state, um, you can get markedly different results. In fact, some prior states to a divergence could be all losing. So
Sure.
that could be where all the losing trades are. And one thing I found interesting using this tool is there's times that the intermarket relationship decouples,
Mm.
and they actually could decouple for a period of time, and you'll say, well, it broke down. Well, it didn't break down. And what I'm finding out is about half of decouples are actually because you keep coming from a state that doesn't work.
Okay.
So
So
they
there's
didn't
certain
really
states,
right,
there's
they
certain
didn't
states
really
that maybe you want to avoid.
exactly, they didn't really decouple. It just happened. So for example, if you're in a state um where you don't want to trade, if the prior state was they were both in an uptrend for a certain intermarket pair, positively correlated, that might be a state you don't want to trade.
Right.
So every time that state occurs, you find out that when you get the divergence for the current state, you want to ignore it because that's where it looks like they decoupled, but they really didn't.
Sure, sure. No, it makes sense. And this is great. So you can go back and review these states. And I think there's probably would there be four different states?
There's four states. So both of them are positive. I call state one. Both of them are one's positive. The market we're trading is positive, and the intermarket is negative, is state two. Both are negative, which is state three, and the market we're trading is negative, and the intermarket is positive, is state four.
Okay,
So this tool is also interesting in another way. There might be times that um, that the state where both bonds and UTY are positive
sure.
might be a good entry point, depending what the previous state was,
Ah,
even though that's not a divergence.
yep. It's
That's
technically not a divergence. In fact, you're just looking through a particular change between two states.
right. So that actually it could be very powerful. I mean, so you could be looking at an oscillator and looking for states. So you might want to know what happened to MACD, for example, and forget intermarket for a second, and what state between the two indicators
Sure,
between the price series and an indicator. So you could be looking for divergences and relationships there. So you could be looking at bonds versus plus DI minus DI, and what the current and prior state was to see if there's any relationships.
excellent. Okay,
So we've got this setup here on what the states are. So let's look at our intermarket. So for bonds, we're buying state four normally and selling state two.
yeah. So let me review that with state four. There, that's your traditional buy. So that's our tradable. The Treasury bonds are going down. That's what the little negative means. And then the next one, that's the intermarket, which would be the utility, is going up.
Correct.
That's our traditional buy signal.
So now let's go look at this in real life. I actually looked at what I found was the short side of the market. This was very, very cool.
Yeah, I think you remember telling me about this because you picked the short side because, well, there's, bonds have been going up. So if you can demonstrate coming up with a system that does well on the short side, they can really demonstrate the power of this.
Right. So you can see we're 66% accurate on the short side in bonds. We make $55,000. Now, let me show something here, which is going to be the optimization of the tool. So I have this all set up here, and you've got all these filter. You got filter here too.
Right, which we haven't played with.
Right. You can also -1 means you're trading daily bars. You're not you're holding overnight. You could actually put an end time in here. So if you put the time of the bar prior to the close of the market, you can turn this into a day trader.
Gotcha.
And actually, that's a big use because what happens is a lot of times these intermarket divergences are just below the threshold to make it a valuable day trader. So, for example, you'll have a lot of intermarket relationships on the S&P that that if you were day trading might make $50 a trade.
Hmm.
But there could be two states that lose money. So all of a sudden you're averaging $120 a trade.
Oh, so suddenly it becomes possible then.
Exactly, because you eliminate the states that lose money. So let's do this optimization.
Okay, let's see how this
Okay.
works with the
Our
optimizer.
our normal state for a buy, which in this case, since we're doing the short side, it's going to be a buy to cover, is 4. Our entry state for a short position is 2. We're going to optimize from 0, which means don't care, which is basically what the normal intermarket divergence is. Look at all states
Okay, right.
through the
So,
4 states.
okay,
And on the short side, the previous state, we're going to do the not care again, all the way to state 4. So we're going to optimize the previous states and see what we get. Now you could optimize all of these, but I'm trying to keep this simple so you can understand. So you
sure.
could find out if there's other states that, based on the previous state, give you good signals, even if they're not divergences. So let's optimize this. Okay. So we optimize this, and what we see here is our previous states being 0 makes $50,000.
Okay, that's our traditional
That's
intermarket divergence.
exactly. That's the same thing you can get with just the Intermarket Divergence Pro. And that's 59% winners. Not bad.
Nope.
Max drawdown of 18,000. And we see the number of trades is 197.
Okay,
Okay, but if we require the previous state
to be 3.
to be 3 on the entry, we make a little more money, 55K. We cut out 87 trades. Our winning percentage goes to 66%,
Ah, okay.
and our drawdown drops to 9,800.
Right. So it looks like you eliminated a lot of losing trades.
Exactly.
Yeah, so that's great. So what is that? That's previous state is 3. So what state is that? What does that mean?
All right, let's go back to our code. Our previous state is 3 is they were both negative.
Okay. So
So
in
they
this
were
case,
so they were both negative, and UTY turned positive.
right, right. So that's important to note. So what that is, the previous state to the current one means that both our intermarket and
No,
our
actually,
tradable was
right,
negative.
right, right. They were both negative in the previous state.
Yep. Gotcha.
So then, because that's on the entry, so what happened is bonds then turned positive after they were both negative.
Yeah, that was going to be
And that's
my
and
second
that's
question is
and that's the one that's the actual state you want to be in. Because remember that the state that allows us to short it is bonds are in an uptrend, UTY is in a downtrend.
yes. And
So the
that's
previous state was they were both in a downtrend.
yeah,
Bonds turn up, UTY stays down. That's when we want to short.
interesting. Yep. That's excellent. So that's what this tool allows you to do is test that previous state like that. And in this case, it really allowed you to eliminate a bunch of losing trades.
Think about what we've put together here with all these tools.
Sure.
This is the same level of research that large institutions are doing. So with your copy of TradeStation and a real fast computer, you can now compete with organizations that have $1 million budget just
Yeah.
by letting your computer setting up these experiments, shotgunning 50 markets, let it run, and building these systems.
Yeah, well, I think what we have here is a real suite of very powerful tools that can be used to build systems. That is clearly for sure. Well, I thanks again a lot, Murray, for taking the time out, explaining this stuff. I know I found it very interesting, and I'm sure a lot of viewers found this extremely interesting as well. And I just want to highlight to everybody that Intermarket Divergence Pro, the Intermarket Optimizer, are some tools that I personally would recommend everyone have because they're just fascinating and they can also create great looking systems for you very quickly. They're very powerful tools. And in this special that we have running through this week, Murray's also kind enough to throw in your 3D optimizer, correct, Murray? Which is for
Right.
it's a plugin for Excel.
Correct. That will let you look at how robust the optimization surface is. I'm throwing in this white paper,
Yep.
which has the write up explaining this system and all the code for it. You're going to get this system, so you're going to be getting an S&P system that's made 165,000 over the last 8 years
Yeah,
as part of the package.
it's a very impressive package because that code is extremely interesting to look at. And believe me, when you look at the code, it's going to get ideas flowing. That's for sure. When I see that, I start thinking of ideas that I want to test following that template.
And the system has done well recently, and the thing is over time, like if this system continues to perform like this for another year, I'm going to be selling this system and the white paper for $500 alone.
Clearly, that's yeah, it's probably wise to do. So really, you're getting an awesome value here with all of this, and of course, obviously, this comes with the equity curve feedback. So you're getting all this for this one low price, and that's only going to happen through this week. After that, we're going to this package is no longer going to be available.
And
So
one other and
yeah,
then one other thing I'd like to say that if some of you have bought pieces of this
oh,
package,
good point.
you can email me at info@usingeasylanguage.com, and I will make depending which pieces you bought, we'll work on pricing so that you can get the rest of the package.
Excellent. Really appreciate it. So I hope you found this enlightening. If you did have further questions on, go ahead and send them to Murray or send them to me, and we're going to do our best to answer your questions. And I guess with that, Murray, thanks a lot for your time and everything, and really appreciate it. All this looks awesome. So I guess until next time, everyone, take care.